are people paying the bills? If your cost of living is rising faster than your wages are rising, that means every month you're either having to go without or rely on savings or go into debt. Number one, let's take a look at household debt. Look at that. It has absolutely been skyrocketing. There's a little bit of a dip in 2020, but household debt has continued to climb. So households are continuing to dig themselves into a deeper and deeper hole, maintaining their standard of living maybe, or maybe not letting it fall as much, but going into debt as a result. And unfortunately, these savings have dried up. If we take a look here at personal savings as a percent of disposable income, we saw there was a spike in 2020, a little bit of a spike there in quarter one of 2021, but the savings are gone now. So people have been relying on savings in order to maintain their standard of living. Those savings are gone. So they are either going to have to decrease their standard of living or continue to rely on more and more debt because this savings pool is now spent. And the worst part about this is that the higher cost of living for everybody is not primarily located in the luxuries, the things that people don't need. It's located primarily in the things that people do need, like food. In fact, the annual gain in food costs was the biggest since 1981. With baby food, like formula, we're seeing major baby food shortages right now. Things like that are what is skyrocketing in price, and the cost of fats and oils used for cooking rose the most since 2008. Now, specifically with these cooking oils, we've seen things like soybean oil, palm oil, vegetable oil, canola oil. All these cooking oils have been skyrocketing in price. A lot of that actually is due to Russia invading Ukraine. The solution, if the Federal Reserve actually wants to curb inflation, would be to hike rates to 5% or higher, according to Dudley, who is the former Federal Reserve Bank of New York president. And here's where things get dicey. If we look at interest rates, if we look at yields today, we see at the short end of the curve, interest rates have been increasing. This is factoring in the higher likelihood that the Federal Reserve will continue to have to raise rates, maybe by 0.5% each time throughout the rest of this year, as inflation is a lot more sticky than what they thought. They're going to have to raise rates to try and stop it. However, if we look at the long end of the curve, 10-year, 20-year, 30-year, rates have declined. This means that the market is pricing in the higher likelihood that the Federal Reserve will have to continue to hike rates to fight inflation, but that it will spark such a big problem that it's pricing in the fact that at a future date, the Federal Reserve will have to lower rates again to deal with the economic collapse. In fact, Dudley says he thinks 4 to 5%, and maybe in the future he might even say 5 to 6% is where the Fed will have to get interest rates to be able to effectively fight inflation. He says the Federal Reserve has to tighten enough to slow the economy down and push the unemployment rate up. That's what's required, and they should be more forthright about explaining that to the American public. So he's basically saying here, we need to cause jobs to dry up, we need to cause the economy to slow down so that wages stop going up and people stop having the income to be able to spend that continues to drive prices higher. And this is the insidious nature of central planning, because you have a few people, ivory tower elites, who are deciding the fates of all American citizens who are trying to work harder, save money, maintain their cost of living, and you have a few people who have been for years now determining, hey, the best thing for Americans is to punish the savers so that their savings lose purchasing power so that we get prices to rise. And now that that's happening, and the standard of living for Americans is starting to get squashed because inflation has been increasing more than wages, now they're coming out and they're saying, now we need to wipe jobs out because people are making too much money, it's driving prices up too much, so now we need to come at them from the other side. We just hit them with the uppercut, and now we need to finish them by wiping out jobs and causing a bunch of economic pain to slow down these prices rising. The reality of what's happening here is that all of the crises that we've experienced economically for decades now are the creation of central planners, the creation of monetary and fiscal policy. And every single time you try and bail out the crisis and stop it from happening, all you're doing is creating the next one even bigger, and that's what we're going through right now. This is not the result primarily of Russia invading Ukraine or the pandemic. It is the choices that central planners make that influence everybody's financial lives. And they don't have the foresight to see that all of the things that they're messing with now are just causing worse problems down the road. See that in 2020, obviously, the growth rate in the money supply spiked and then was growing really quickly year over year. But then in 2021, early 2021, the growth rate of the money supply really started to slow down. That was mainly because of political gridlock. And so the growth rate of the money supply started to drastically decline. Now, the thing to remember about monetary policy is it takes time for it to work its way into the real economy. It does not happen immediately. The changes in monetary policy do have a very quick effect on markets, especially bond markets. However, they do not impact the real economy immediately. It takes a lot of time for that change in money supply to work its way throughout the economy. So the inflation we've been experiencing is starting to come to the end of that growth rate of the money supply. That was a big spike here up until early 2021. Now since about a year ago, we've been experiencing much lower rates of money supply growth than we were experiencing before. So my anticipation is that the inflation rate will actually start to come down. Not because the Fed is fighting it now, but because the growth rate of the money supply very much slowed down over a year ago, and it's been slowing down ever since. This means the Federal Reserve is tightening into a situation that was tightening by itself already from the decline in the growth rate of the money supply, which is essentially a rug pull out from underneath the economy. So it's getting tightening on one side from a year ago when the money supply growth started declining, and then it's getting tightening from this side when the Federal Reserve is starting to raise rates and sell assets off of its balance sheet. And so I think there's a very good chance this tightening, they overdo it and tip us over into a crash, into deflation, into some economic crisis that they're going to have to go back and reverse yet again. In the end, we will see what happens, but this is glaring evidence that it is time to end the Fed. We do not need a small group of people who are disconnected from economic reality making decisions that influence the financial lives of every single American citizen. Not only are they not helping, but they're actively making things worse.